Yo, look at this big fat juicy bearish engulfing candlestick that just broke my support level. I'm gonna enter for a sell right here. Nice. Let me pre-order my Porsche 911 real quick. No. If you've ever been stopped out just like this, understand that it's not a coincidence. It's market manipulation. If you're still trading candlestick patterns like engulfing or pin bars, then you are trading exactly the way banks want you to do it. They use these exact candlestick patterns to bait retail traders just like you. So in this video, I'm going to expose all of them. I'm going to show you how to spot these traps and how you can trade with them rather than against them. First of all, you must understand that banks, they don't chase price or stupid candlestick patterns just like this. They engineer liquidity. This means they create setups to trigger retail emotions and then move the opposite way, just like this example right here. Retail traders think this is a breakout, but smart money sees this as a liquidity grab. So what is a manipulation candle? A manipulation candle is a price action pattern designed to trigger emotions, sweep liquidity, and then reverse. Smart money use them to create an illusion of momentum, but it's all just a bait. And if you're not aware of it, you will keep on getting faked out over and over again. The first manipulation pattern is engulfing candlestick within a consolidation itself. When retail traders sees a consolidation just like this, they'll mark their support level here and their resistance level here, and they'll be waiting to trade the breakouts. So the moment there's a bearish engulfing candlestick just like this that breaks below a support level, this induces the retail traders to actually enter for a sell right here, thinking that price is gonna break out to the downside right now. But the thing is, once again, that's an illusion, right? When this bearish engulfing candlestick appear, this induces fear of missing out, right? Because retail traders, they see this big bearish candlestick and they immediately want to get in and be part of that huge move which is about to happen. Or at least that's what they think. Meanwhile, smart money knows that and they purposely reverse price after it swept all the available liquidity below all these lows right here, right? So imagine if you're a retail trader today, you're going to be entering for a sell right here and you're going to get stopped out. And then once you get stopped out, your sell orders get converted into buy orders, which gives smart money the fuel they need to push price up. Right, so in this case right here, what happened was that we got a bearish engulfing candlestick that broke below this support level. Retail traders enter for a sell, but smart money actually used this as an opportunity to sweep all the available liquidity below these lows right here and cause price to go up there. And then once again, once price goes back into this consolidation, if retail traders are still blindly trading based on engulfing candlestick, they're gonna see this as a big bullish engulfing candlestick that just broke above their resistance level. So that is where they will start entering for a buy right here, once again, just for smart money to push price down even further, right? So their buy orders is essentially just liquidity for the smart money to actually fuel their bearish momentum. So the solution to this is you don't just want to be blindly trading candlestick patterns or engulfing candlesticks within a consolidation, thinking that it's going to break out anytime soon. You want to understand what's the directional bias, right? So if we zoom out to the higher time frame, you will see that over here, price actually went up, pulls back and then start consolidating, right? So if you look at the higher time frame order flow, is actually bullish. So this consolidation is just a pause in price for price to, continue the up move later on. So we know that in this particular scenario right here, price is most likely going to come down and sweep some available liquidity below these lows right here, stopped out all the retail traders before we get the move to the upside. Right, so just by understanding the purpose of this consolidation, you manage to avoid false breakouts just like this, right? You wouldn't be entering for a sell right here. You will know that the purpose of this consolidation is just for us to get more liquidity to fuel the continuation of this bullish order flow. An alternate solution is to wait for the candlestick body to fully close above or below your support and resistance level for further confirmation. But the thing with this solution is that it's still prone to a bunch of fakeouts and liquidity grabs. So I'll just advise you to stick to the first solution, and that is to understand directional bias of the market, the order flow, before you think about how to trade within this consolidation itself. So the next manipulation pattern is what I call inducement traps. And this is usually some form of reversal candlesticks like the morning star, the evening star candlestick at a key supply and demand zone. In this case right here, we can see that this is a demand zone, right? Which means that we're expecting price to pull back to this demand zone and continue, right? So a lot of retail traders, what they will do is that they'll wait for price to pull back to the demand zone and then show some form of reversal candlestick pattern. Like in this case right here, this is actually your morning star candlestick pattern. So this inducement trap actually entices retail traders to enter for a buy early, and this is where they're going to be placing their stop loss below this low right here. But little do they know, this is actually just a trap laid down for the smart money to grab all the liquidity below this low right here before we can potentially get the strong move to the upside, right? So as you can see right here, let's see how did this trade play out. Price came down there, stopped us out, sweep the liquidity below this low, tap into this next demand zone before we get the move to the upside, right? Before price actually go in your way. So the solution to this is don't just enter at a point of interest just because you see like a reversal candlestick pattern, right? Because sometimes we need more liquidity before price can actually move in the desired direction. So in this case, you'll be much better off if you just wait for further confirmation. You wait for the structure to shift, right? You wait for this internal structure to shift bullish by waiting for some form of market shift that we have right here. And then you also wait for liquidity to be swept before you actually look for your entry itself. So in this case, I personally would not have entered blindly at this demand zone right here. I'll wait for a market shift to happen, and then I will also want some form of strong liquidation before I actually look for my entry. The next candlestick is actually an interesting one, and that is the long wick candlesticks. Right, so long wick candlesticks are basically those candlesticks with like a relatively small body compared to the candlestick wick, the length of the wick, and it could have like a long upper wick or like a long lower wick, right? So in this case, this one have a long upper wick, and you can see this one just broke past this resistance level that we have right here, right? So a lot of retail traders, they see this as a breakout and they start entering for a buy right here, just for price to reverse against them, right? You must understand the rationale behind this long wick candlestick. What happened right here is that at some point of time, bullish momentum actually stepped into the market and caused price to take out this high right here. But then there was insufficient demand in the market for price to continue this bullish momentum, right? So sellers actually came into the market and suppressed price, right? Caused price to push down, and that is why this candlestick ended up closing instead of somewhere right around here to become a bullish engulfing candlestick. In this case, what it actually tells us is that price has actually rejected this level and supply is stepping into the market. There's a lot of supply right now and we could potentially head to the downside. And banks just push price far enough just to trigger all the stop loss that we have above these highs from all the retail traders who entered for a sell right here. So this is not a breakout, this is just manipulation. So in this case, instead of entering for a buy and trying to trade the breakout, you want to trade the manipulation, you want to trade the liquidity sweep, right? So in this case, price actually swept the available liquidity above these highs right here. So this is where you can potentially look for shorts, and you can see what happened next. Price just continue to just collapse and just hit back down. And if you look at what happened, price actually pulled back to this supply zone that was created from the liquidity sweep. And you can see after it pulled back to this supply zone, fill up the remaining sell orders, it continued heading back down. And just to show you another form of classic market manipulation, you can see the price was just approaching this demand zone that we have right here. And you can see this candlestick actually broke below the demand zone, right? So this is where a lot of retail traders will try to sell the breakouts, right? Just for price to reverse and hit back up. And in this example right here, if you look at the candlesticks, you can see it's multiple candlesticks with a long lower wick, right? You can see this one have a long lower wick, this one have a long lower wick, and this one as well, which tell us that price is rejecting this demand zone multiple times, right? So this demand zone is most likely going to hold and price is actually going go back up. So we can use these multiple wick rejections as a confirmation to look for buys. And you can see after you look for buys, where did price pull back to? Once again, it pulled back to this demand zone that swept all the available liquidity that we have below these lows right here before it actually moved back up. Another common candlestick pattern that retail traders like to trade is the inside bar candle, right? So inside bar candles are pretty much just innocent little candles that fail to break out the previous candle high and fail to take out the previous candlestick low, right? So a lot of retail traders, when they see this, is that what they will do is that they'll place like a buy order above the high of the mother candle, which is this candle right here, and they'll place a sell order below the low of the mother candle, right? So they'll pray for the best and they hope that price actually move in one of these two directions, and then they can tap into the trade, and then they can trade the continuation of the breakout. But more often than not, that's not the case, right? So in this case, you can see what happened is that this was the mother candle and then price breakout to the downside, right? So this is where all the retail traders who place like a sell order right here would have been triggered, and then they'll place their stop loss above this candle, right? And that is when once again price just reverse and just go back into this consolidation. Same thing right here where price break to the upside, trigger their buy order, and then go back into this consolidation right here. And this is really just smart money accumulating more orders, stacking more buy orders, so that when price actually break out, they can capitalize on the opportunity itself. Right, so the solution to this is simple, right? It's not to place a buy order above the high of the mother candle and below the low of the mother candle. Is to just wait for the candlestick to close above the high or the low, and then potentially you can trade the continuation of that move, right? So in this case, you can see this candlestick right here finally closed above the mother candle, and this is where we know that price is potentially about to move to the upside. The final manipulation pattern is one that retail traders often fall victim to, and that is the gap candles. So we know that when the market opens after a weekend, it usually gaps, right? So in this case, it actually gapped down, right? So you can see this was on Saturday, or rather Friday, when the market actually closed, and then when it opened, it actually gapped down. And when it gapped down just like this, a lot of retail traders think that this is bearish momentum, and they start entering for a sell, thinking that, oh, maybe the market sentiment shifted bearish over the weekend and right now price is about to collapse. But then when the market actually opened, yes, we did get a gap down, but we got a bullish candlestick in this case, right? So you can see it's like conflicting buyers right here. You think that market is going to go down, but the market actually shows you that it could potentially go up, right? So what do you do in this case? So this is a very obvious trap to actually trick all the retail traders who are trading the gap, right? Thinking that price is about to go down. So what I will personally advise is that instead of trading the gap, you want to trade the reaction to the gap. You want to trade what happens after the gap itself, right? So you can see in this case, even though price gap down, I wouldn't enter for a sell. I'll probably enter for a buy. So what happens after the gap is formed, right? So in this case, we got a gap down, but then there was bullish candlesticks actually forming at this demand zone, right? So it's giving me clear confirmation that price is potentially going up right now. So instead of trading a subjective bias of the market, thinking that price is going to go down, why not trade the objective truth of the market? And the market is clearly showing us that price is going to go up, right? So you can potentially look for longs right here, right? So in this case, you can see price did went up, right? So we are not just blindly trading the gap, we are trading the reaction. We are trading what's actually going on in the market itself. Once again, the logic behind this is that smart money use these gaps to get retail traders who are chasing price, trading the gaps. They know that traders, they are taught to trade the gaps or the breakout of it. So they let everybody pile in their sell orders, and then they fill the gap and then actually reverse price. And by the time you realize that this was like a fake momentum, you're either stopped out or you are buying at the top. Now you must understand that these candles, they are not entry signals or confirmation or confluences. They are actually psychological traps laid down by smart money. And if you keep trading these patterns without context, you're just gonna keep on getting stopped out and losing money. But once you start understanding what this candlestick actually means, it's like unlocking cheat codes to a video game. You stop reacting like a retail trader and you start moving like a professional. With that said, if you want to learn from a six-figure professional trader, click the link in the description to apply for my mentorship program, 1% Club, and I hope to see you there. And as always, remember you're just one trade away. Mwah.